The Dow fell on Tuesday as Apple shares slid. This marks the first session in 6 that the mega cap stock did not help lift the markets. Here to tell us what investors should expect next from the top-heavy market is Mona Mahajan, portfolio manager and U.S. investment strategist at Allianz Global Investors, and Greg Branch, partner at 1847 Financial. Good morning to you both. Mona, I will start with you. You know, in the past few days at least, we've had analysts just tripping over themselves, raising price targets on stocks like Apple, which got a new street high price target yesterday, followed by one the day before. This morning, we've got a new street high price target on Tesla. We'll talk to that analyst later on in the show. What kind of market is this, given that analysts are just sort of playing catch up with the big move in the mega cap stocks?
Yeah, no, thank you, Melissa. Great to be here. Generally, we continue to feel that this is a market that's pretty heavily supported by some strong technicals. And those include things like, one, of course, the ongoing stimulus from both fiscal and monetary, which not only, keeps rates low, but adds liquidity to the system. And that liquidity is being pushed out into the risk asset marketplace. Two, we certainly have still elevated levels of cash on the sidelines, particularly institutional investors. There's a healthy amount of skepticism on this rally still, which ultimately helps the market climb walls of worry. And then three, of course, we have technicals in the sense that the S&P has now reached and breached an all-time high. We went and surpassed that 3386 level reached on February 19th. We're comfortably above 3400 now. From a technical perspective, that's bullish as well. And so we continue to feel like the backdrop is benign at this point. Could we get a period of consolidation given what's coming up? We have a September pre-election period. We have the fall season where virus trends may be in question. But generally speaking, we think any sort of period of consolidation lends itself to another buy the dip opportunity. So overall, the question will be going forward, what is it that drives that market to next leg? Is it the tech and the growth sectors, which tend to do well when there's questions around the economy and the virus, or is it that reopening or cyclical sector that tend to do well when we hear better news on vaccine and reopening generally?
Yeah. Another thing helping these growth stocks, the leadership in the market, Greg, is low rates, low interest rates. And Fed Chair Powell has made it clear that interest rates will remain low for a very long time. Although we have seen a slight tick up in the past week or so. We're now at 2-month highs on the 10-year yield. And I'm wondering if you think that there's anything to this backup in rates, if there's any catalyst, if there's anything that the market sees that is causing this.
Right. One of the things that we've been looking at is the narrowing of breadth in the market, because it has tended to be a pretty effective forward indicator for what's going to happen in the real economy. So we saw breadth narrow fairly acutely heading up into the 1980 recession, up into the 1990 recession, and then from 1998 up until the 2000 recession, and most notably in 2008, of course. And one of the things we're seeing now is really narrow breadth in the market. And so that's at least a warning sign for the underlying economic fundamentals. We'll have to wait and see whether or not the market ends up reflecting that. But you're right. As long as the central banks are going to continue to pump liquidity into the system, as long as interest rates are going to remain low and there's easy and cheap access to credit for companies, that's going to provide some type of backstop for where the equities are trading.
Mona, we're all looking forward, of course, to Jerome Powell's Jackson Hole. I guess it's not Jackson Hole this year, but the Kansas City Fed virtual symposium and the speech that he's expected to deliver at 9 o'clock on Thursday morning. Part of the expectation is that he'll talk about inflation targeting and letting inflation run hotter for longer, which seems a little odd given there's no inflation right now in the market. I mean, do you think that this will be any sort of market catalyst?
I think the market is starting to price in this new Fed regime where they are hopeful that they can get inflation back into the system, and they are hopeful that they can get it back over that 2% target for an extended period of time. What we're seeing that, or how we're seeing that manifest in the marketplace, well, one, clearly rates have creeped higher, but two, we're seeing this ongoing push with gold. Gold has become not only a favorite when rates are low and negative, but also as inflation creeps higher. And then three, the dollar has started to weaken, and that's supported things, risk assets like emerging markets that are more dollar centric. And so we're starting to get this new regime being priced into the marketplace. it's partly the Fed, but it's also partly this expectation that the global economy broadly may begin to recover over the next, call it 12 to 18-month period. And so I think it's a combination of those two which are driving some of those market factors that we just discussed.
Greg, can you get behind the valuation of, I mean, there isn't really no valuation, but the value of gold right now? It is amazing that we live in a time where people, portfolio managers, investors can favor mega cap growth stocks and then also gold in their portfolios.
Right. Yeah, and look, I don't think that those things are mutually exclusive, particularly if what you're trying to do is hedge. But what we'll start to do is we'll start to turn to 2021, particularly right after the election, and we'll start to look and see where the earnings growth is. And so what I think will happen is that outside of a few names, we're going to see a reversal. We're going to see names outside of tech actually demonstrate much more powerful earnings growth than some of our favorite tech names right now. And when you look in 2021 and you see a sector and certain names within it trading at 50% on its 5-year historical average, when you see 100% plus earnings growth, and in some cases even offering a yield, I think we're going to start to see rotation out of some of those more growthy names that perhaps can't support a superior or superlative multiple into 2021 because the earnings on a relative basis just don't support it.
Yeah, intellectually, it's easy to make that argument, Mona, but if you're a portfolio manager benchmarked to the S&P 500, it's harder to actually make that move and that rotation as tech continues to lead.
Well, yeah, I think the market will do it.
Mona, sorry.
I think the market will do
Mona,
it with you.
Last word.
Oops. Yeah, no, thanks.
Okay.
I think generally it's important to keep that barbell. Look, we think secular growth is here to stay. We think that's not only a 1-year trade, it's a 3, 5, 10-year trade. But as we get through the next 12 to 18 months, when you get the tactical opportunities, continue to build some exposure to the cyclicals. And that includes not only, the airlines and the hotels, but think about things like clean energy. Think about areas like housing, which continues to do well. And also think about areas like that can do well in both environments, including med tech and even, mobile payments, for example. So there are areas that you can broaden into that are not just, the value growth barbell. So important to keep diversified as we get through this next 12-month reopening period.
All right, Mona and Greg, thanks a lot. Good to see you.
You're welcome.
Thank you.